Setting up the wrong legal entity can be a disaster. Therefore, visualizing and thinking through your long-term business plans is super important. But most people overlook this step. So in this video, I'm going to review 4 of the primary types of legal entities to identify. 1, the basic formation and structure. 2, the tax structure of each. And then 3, the pros and cons of these legal entities. Before we dive in, this video is for educational purposes. If you're going to set up a legal entity, I highly recommend talking to an attorney and a CPA before you do so. Now, with that out of the way, let's dive into this video. Limited Liability Companies, LLCs. Now, LLCs come in several flavors. You can have single member LLCs, you can have LLCs taxed as a partnership, and you can have LLCs taxed as a corporation. Now, LLCs taxed as a corporation, I'm going to save that for part 4 of this video, and I'm only going to focus in on single member LLCs and LLCs taxed as partnerships. Now, single member LLCs, these are going to be your independent contractors, your sole proprietors. They're going to be the sole owner of the LLC. And this sole owner is looking for liability protection to separate the business assets of the LLC, the business that they're running, and their personal assets. They're looking for that liability protection. LLCs taxed as a partnership will have multiple owners that own that business. There's multiple people involved with the business that have a ownership stake. And LLCs are considered pass-through entities, meaning the LLC taxed as a partnership will not pay taxes. The individuals who own it will pay the taxes on that entity. But LLCs taxed as partnerships offer that liability protection that people want to separate personal assets and liabilities from business assets and liabilities. The Articles of Organization is the governing document over a limited liability company. This is the document that you're going to file with your state when you set up the LLC. This is where an attorney can be super helpful when filling out this document, because you got to define what the purpose of the LLC is, along with filling in all the additional information when you're setting up the Articles of Organization. The tax structure of a LLC. A single member LLC is very easy. You don't need to file a separate tax return. Single member LLCs, when you have a sole owner of a limited liability company, the activity, the revenue, and expenses will simply go on the 1040 of the owner, and it will go on Schedule C. You will file Schedule C like any independent contractor, sole proprietor, for a single member LLC. Revenues, expenses, go on Schedule C, ultimately getting down to taxable net income. LLCs taxed as a partnership will file a separate tax return. It will file Tax Form 1065. A 1065 tax filing is generally due March 15th, and it will provide the members' owners a K-1. The members will report the LLC K-1 on their 1040. A little different than a Schedule C for a single member LLC. You're effectively reporting the net income, the different aspects of a K-1 on your 1040 from the 1065 that was filed. Let's go through a quick example of an LLC taxed as a partnership and how the income will get broken down. This LLC has $1 million of net income. The LLC member, Helen, owns 35% of this LLC. Helen will receive a K-1 for $1 million times her 35% ownership, effectively providing her a K-1 with $350,000 of taxable income. Now, it's not always as clean as that. There's a lot of categories if you've ever looked at a K-1, but for simplistic measures, if it's just business income, Helen has $350,000 of K-1 income from her LLC. All right, let's go through some pros and cons of limited liability companies. Pro number 1, the setup. Setting up an LLC is easy. You go to your state's website, fill out the Articles of Organization, pay the fee, and in a couple weeks, you have yourself an LLC. Pro number 2, the cost. The cost of setting up an LLC is comparatively inexpensive. The maintenance costs, especially with a single member LLC, will be relatively inexpensive compared to our other three options in this video. A multi-member LLC will definitely cost more than a single member LLC since it does require greater bookkeeping and a separate tax filing. You have to file tax form 1065 to generate the K-1s for all the owners. It will be less expensive than most partnership filings, S corporation filings, and C corporation tax filings. Pro number 3, flexibility. Multi-member LLCs give you flexibility on the amount of members you want to add and flexibility on how to pay distributions. In other words, LLCs can have unlimited members and don't have to pay distributions pro rata to ownership. This advantage will make a lot more sense when we look at S corporations. Con number 1, payroll taxes. Single member LLCs and LLCs are considered self-employed and will be subject to payroll taxes. This can surprise a lot of new business owners that you're subjected to Social Security and Medicare taxes. You have self-employed income from owning a limited liability company. Con number 2, transferring ownership. Transferring ownership and membership units can be challenging with an LLC. There are certain states that will make you start a brand new LLC if a owner sells a partial piece of the LLC. It also can be challenging trying to value what that limited liability unit is worth. LLCs are not easy to transfer and sell units from. Con number 3, raising money. It is really challenging to try and raise money in a LLC for various reasons. Between payroll taxes, challenges of buying and selling the units, receiving a tax form K-1, owning shares of an LLC as an investment can be unattractive to investors. If you've gotten any value out of this video so far, please smash that like button and consider subscribing. All right, let's go into partnerships. Partnerships can look and feel like limited liability companies, but partnerships have different aspects to them. A basic partnership will involve 2 or more people who have shared ownership in an entity. And we have 2 basic types of partners. You have general partners and limited partners. General partners, they will be the partners typically running the business, making decisions, responsible for the business results, and ultimately hold the most liability of the partnership. On the other hand, you can have limited partners. Limited partners will have limited liability to the partnership. Limited partners will play a more passive role in a business, and they're more likely going to be an investor in that partnership. Now, several types of partnership structures include a general partnership, what we've kind of talked about so far. This is where, at minimum, 2 or more people have ownership in the partnership, and those partners are personally liable to the debts and obligation of the partnership. A limited partnership, an LP, will have a general partner with unlimited liability and limited partners with limited liability. The general partners will typically be the ones running the business. The limited partners are going to be the ones investing money, cash, capital, whatever into the business. Limited liability partnerships, an LLP, gives each partner limited personal liability, which protects the partner against partnership debts and actions taken by other partners. You'll see LLPs with a lot of professional services companies. These are where partnerships are coming together, combining their skill sets, whether it's attorneys, whether it's CPAs, and each partner wants limited liability to the overall partnership and actions taken by other partners in that partnership. All right, let's go over some taxation considerations when you're setting up a partnership. Like an LLC, all partnerships file tax form 1065, and all partners, owners of the partnership, will receive a K-1, which they will report on their 1040, and that's where the taxes gets paid. This is a pass-through entity. In our quick example of K-1 income from a partnership, an LLP in this scenario, we have $1 million of net income from the LLP, and member Paris and partner Paris owns 25% of the partnership. Paris will receive a K1 for $1 million times 25% of his ownership, ultimately getting $250,000 of K1 income, which Paris will report on his 1040. I also want to mention this concept of basis at this point in time. Basis will apply to pass-through entities. Therefore, owners of a pass-through entity like an LLC, an S-Corp, or partnership will want to understand what basis is. And at its simplest form, when you contribute money to a partnership, LLC, any sort of pass-through entity, that will increase your basis. If you can think about stock basis, that is your basis if you ever go to sell or get a distribution from this pass-through entity. What increases your basis within your ownership of your pass-through entity is net income, or if you contribute any more money. Those particular items at its simplest form will increase your cost basis, your basis in the pass-through entity. What will decrease your basis in a pass-through entity is distributions. You received money from the pass-through entity, or if there's net losses. Net losses will also reduce your basis, your ownership, your cost basis in a particular pass-through entity. Basis, I just want to point out, is important for distributions and selling any ownership in the future. So you want to have a good idea what your basis is to get an idea what your gain might be if you ever sell your pass-through entity ownership. All right, let's go through some pros and cons of partnerships. Pro number one, this is an easy way to combine skills in an entity. A partnership is an easy way for two or more people to join forces and benefit from each other's skills. For example, a tax accountant and an audited accountant can form a business to offer full service accounting services to businesses. They can help with the tax preparation, and they can also help with audit, review, compilation work as well to offer full services to their client base. Pro number two, flexibility. Partnerships offer flexibility in the same way that limited liability companies offer flexibility. You can have as many partners as you want, and you don't have to pay out distributions pro rata to ownership. This is a great option, and it'll make a lot more sense once we go into S corporations. Pro number three, raising money. Raising money in a limited partnership is a lot easier than raising money in a limited liability company. The ability to have limited partners gives the opportunity to raise cash for the business. Limited partners have limited liability, and they are also not subject to payroll taxes. Con number one, partners in themselves. Working with other individuals, human nature, can be challenging. Partnerships need a well thought out partnership agreement. Partners therefore need to predict and think about where their business is going, how many partners might join the partnership, and what problems might arise in the future. Now, you're not going to hit everything in your partnership agreement, but if there's some key things, if there's areas that you could see that are going to be contested or be arguments in the future, I would identify those and put them in your partnership agreement from the get-go. The stronger, the more detailed a partnership agreement is, the better off you will be in the long run. Disagreements among partners is inevitable. Con number two, payroll taxes. General partners are considered self-employed and are subject to payroll taxes, Social Security, and Medicare taxes. That can surprise owners of a new partnership that they are subject to self-employment taxes. Con number three, selling partnership ownership. Trying to sell or exit a partnership can be a headache. You will have to navigate the partnership agreement. Once you have navigated the sale, you'll have to figure out the tax treatment for all the pieces that might be included in that sale, which might involve multiple tax categories, meaning you're going to need a good CPA when you're selling a partnership ownership. Our third category of legal entities is S corporations. We're taking the benefits of running a corporation and combining the pass-through taxation of a partnership. Let's see how this one plays out. S corporations do have some rules that need to be followed, and if you don't follow those rules, you will lose your S status and ultimately become a C corporation. So if you're running an S corporation, you want to pay close attention to those rules. One of the big ones is you cannot have more than 100 shareholders. If you go to 101, you go to 102, you're going to forfeit your S status. You got to stay under 100 shareholders. Number 2, only individuals and certain trusts can own shares of an S corporation. An LLC cannot own an S corporation. A C corporation cannot own an S corporation. A partnership can't own an S corporation. You got to be really careful when you have shareholders buying into an S corporation to make sure it's an individual, and there's certain trusts that meet the exception of buying into an S corporation. And number 3, there can only be one share class of stock. Now, you can split it between voting and non-voting, but you can't offer Class A, Class B, preferred. It's one share class of stock with an S corporation. Like its big brother, the C corporation, the shareholders of an S corporation will elect the board of directors, who then elects management. And it's not uncommon for all 3 of those categories to be the same people. You probably have the shareholders on the board who also manage the company within an S corporation. The Articles of Incorporation do govern the S corporation, which defines the responsibility of the board of directors, the officers, shareholders, etc. It will define how many shares the company can also authorize. The Articles of Incorporation is a key document when you're running an S corporation. And again, you want to get an attorney to help you write up those Articles of Incorporation that get filed with your state. I also have another video where I go through shares issued, shares authorized, and shares outstanding to get a sense of what those 3 different categories are. I'm going to link that in the description if you want to take a look at that and get a better understanding what those different categories mean. All right, let's go through the taxation of an S corporation, which looks a lot like a partnership and nothing like a C corporation. S corporations will file tax form 1120S, and like a partnership, will generate a K-1 for all its shareholders. Shareholders will report the K-1 on their 1040 where the taxes are paid. Again, this is a pass-through entity. The S corporation is not paying the taxes. The shareholders are paying the taxes on their 1040. So let's look at a quick example. All right, we got an S corporation again with $1 million of income, and shareholder Hector owns 50% of the shares of that S corporation. Hector will receive a K-1 for his pro rata ownership, $1 million times his 50% ownership to get a K-1, to have K-1 income of $500,000 that he will report on his 1040, and that is where the taxes are paid. S corporation income, unlike partnership and LLC income, is not subject to payroll taxes. You're not going to have to pay Medicare or Social Security with S corporation income. One thing you do want to take into consideration is to make sure you're paying yourself a reasonable salary. In other words, S corporation owners shouldn't just pay themselves distributions and not a salary, which a salary will be subject to payroll taxes. It's a W-2 income. A lot of times people will set up S corporations and pay themselves a $10,000 salary and take all the profits out as distributions to avoid the payroll taxes. There is a reasonable salary test that the IRS can audit you on to determine if you're paying yourself a reasonable salary for your position, for the business that you are in. So you want to be really careful. Don't take the $5,000 salary and pay all the profits out in distributions. You want to have to pay yourself a reasonable salary and then take the rest of the profits out as distributions. The IRS doesn't want you to avoid payroll taxes. They just don't. Pros and cons of an S corporation. Pro number 1, payroll taxes. We just talked about payroll taxes. S corporation K-1 income is not subject to payroll taxes such as Social Security and Medicare. That's a major advantage over a partnership and an LLC. Pro number 2, No double taxation. This is in reference to C corporations. S corporations benefit from pass-through taxation. Distributions reduce the shareholder capital of the ownership in the S corporation, much like basis in a partnership. Distributions are not subject to further taxes like dividends in a C corporation. We will touch on double taxation a little bit more in our next category, which is C corporations, to get a sense of how C corporations, dividends in particular, can be double taxed. Pro number 3, corporate liability protection. You get the benefits of being a corporation, the maximum liability protection that a C corporation can offer with the tax benefits of a pass-through entity. Con number 1, 100 shareholders. You are limited to 100 shareholders in an S corporation. This can be a challenge if you're trying to raise cash, capital to expand and scale up a business. Distributions have to be paid pro rata to ownership. This doesn't seem like a big deal, but paying out distributions pro rata to ownership can create some major headaches when you're trying to develop compensation models for shareholders who run the business. You end up having to pay out more wages, which are subject to payroll taxes, if ownership percentages don't line up with the compensation model. Basically, you're losing one of the pros of an S corporation if you can't get compensation models to line up with ownership. I've experienced this. It can create some headaches. It's definitely a con of an S corporation. Con number 3, setup is more complicated than an LLC and more than likely more complicated than a partnership. Corporations have more paperwork and they're more costly to set up. You will definitely need an attorney and a CPA to help you set up an S corporation. You do not want to guesswork setting up an S corporation. You want to be thoughtful on how that gets set up. The board of directors will have to schedule regular annual meetings and take minutes. There's a lot more corporate governance related to running an S corporation and a C corporation compared to a partnership or an LLC. Our last legal entity is the almighty C corporation. Corporations offer the greatest liability protection, but they are the most involved structure to set up and maintain. Like an S corporation, a C corporation issues stocks to shareholders, and the shareholders elect the board of directors who hire management to run the company. There are no shareholder limits or share class limits when you're setting up a C corporation. This will be defined in the Articles of Incorporation. The Articles of Incorporation govern the corporation much like a S corporation. This will cover items like the board of directors' responsibilities, how many shares have been authorized and can be issued. If a C corporation declares a dividend, all shareholders are entitled to their pro rata portion of that dividend. C corporations can get very complicated. You absolutely don't want to wing setting up a C corporation. And let's go over some taxation considerations because this is very different from what we've talked about so far. Everything has been a pass-through entity up until this point. C corporations are not pass-through entities. They're totally separate entities that pay their own taxes. C corporations will file tax form 1120. No K1 is generated. Every other entity besides the single member LLC generated a K1. C corporations, there's no K1. The C corporation, again, is paying their own taxes. C corporation dividends are also subject to a personal income tax, and this is why a C corporation can be considered double taxation, because the C corporation is filing and paying taxes on its income. And then C corporation dividends are also subject to personal income tax. This is where we can run into double taxation. C corporations are paying taxes on the income they generate on the 1120. And then if they declare a dividend, each shareholder receives that dividend and has to report that on their 1040 and pay taxes on the dividend. So the same income has been taxed at the C corporation level, and then in the form of a dividend, which is still income, that has been taxed, it's getting taxed again at the 1040 level. Now, usually it's going to be qualified dividend rates, which are lower, but it's still a second taxation of the same income. Let's go through an example of double taxation. Our C corporation income is $1 million, and our corporate tax rate is 21%. Our C corporation has net income or taxable income of $1 million, and the corporate tax rate is 21%. So our taxable income of $1 million times the tax rate of 21% results in $210,000 of tax the C corporation is going to pay. Now, if the C corporation then declares a $500,000 dividend of the $790,000 that's left over, qualified dividend tax rate of 20%, that $500,000 that's been paid to shareholders will carry a tax of $100,000 that's reported on 1040s or other tax returns of those who have received the dividend. So in this instance, our C corporation taxable income of $1 million has resulted in $210,000 of corporate tax, and then another $100,000 of qualified dividend tax, which gives it an effective tax rate of 31% on the $1 million of taxable net income. The only time a C corporation shareholder will receive a tax form is if the shareholder received a dividend, which we just went through, or they have sold shares in that C corporation. Other than that, shareholders of a C corporation will receive nada. They're not going to receive the tax form. They're not getting a K-1. Let's go through some pros and cons of a C corporation. Pro number one, raising money. C corporations offer the best structure to raise money and scale up a big business. Shareholders receive shares in exchange for cash and property and don't have to worry about receiving and filing a K-1. The only time they have a taxable event is when they receive a dividend or sell shares. Pro number two, unlimited share classes. C corporations can authorize and issue as many shares to as many shareholders through as many share classes as defined in the Articles of Incorporation. Only limitation is the Articles of Incorporation to how many shares and share classes that a corporation can offer. That is very different from an S corporation, where you can only issue one share type and only have 100 shareholders. Pro number three, selling shares. Selling shares of a C corporation is significantly easier, comparatively speaking, to a pass-through entity. The difference between your cost basis and the fair market value of the sale will be your taxable gain. When you're dealing with pass-through entities and K-1s, it's a lot trickier and can be a lot messier trying to determine what your capital gain is on the investment that you've made. That's very attractive to a shareholder. Con number one, C corporations are the most complicated and expensive legal entity to set up, especially when you compare it to an S corporation, partnership, or LLC. Con number two, double taxation. C corporations get taxed twice. Once at the C corporation level, where they're paying the taxes on the taxable net income of the C Corp, and then again when it declares a dividend, the shareholders have to pay taxes on the dividends they received. Con number three, administration. C corporations are the most administratively burdensome of the four entities discussed. It files and pays its own taxes. You have to keep board minutes of all the board of directors meetings. There's a lot of corporate governance involved with running a C corporation. There's also the aspect of authorizing, issuing, and buying back shares of stock, and especially of different share classes. That's going to get more complicated and complex as the business scales up and grows. Okay, those are our four primary legal entities. As you can see, there's different flavors, there's different considerations when you're setting up your business and what type of legal entity that you want to pick for your business. It does matter. It can make a difference, especially when you start to scale up a small business into a larger business. I hope you learned something from this video. That was a lot to cover. I appreciate you. Have a good rest of the day, and I will see you in the next video. Take care and goodbye. Yeah.